Hello, Ben here from Bounce Financial. I'm just going to do a video today about a case study of a particular client. Now, I've obviously changed all the details to protect the client, but I wanted to give an actual case study of what I guess a client would come to us with and how we would go about preparing advice for that particular client. So, in this scenario, the husband was 61 years old, works full-time, makes $175,000 plus super. The wife is 59 years old, works part-time, and makes $60,000 plus super. So really good family income, heading into retirement, kind of wondering what to do. They did have children, but they're all grown up, they're all looking after themselves, so nothing to really worry about too much there. Couple of key things: they had a home that was worth about $1.6 million, intending to stay in the home long term, so the value of the home is probably a little bit irrelevant. But importantly, they owed about $220,000 on the home, so there's still a bit of a mortgage there. They had an investment property which was through the husband's name. It was worth about $680,000. They owed $420,000 on it, and it rented for about $510 a week. So a little bit of equity in this, but not a huge amount necessarily. They had money in their offset account, so they had about $100,000 in their offset account, and their super balances were about $660 for the husband and about $180 for the wife. So that's loosely, I guess, some of the key things about these people. They essentially came to me with a couple of goals. So obviously retirement was on their mind. They were discussing buying another investment property. They were looking for ways to earn passive income in retirement, and were trying to identify how best to go about that. They wanted to obviously pay off their house. And they obviously wanted to be out of debt, but they wanted to do some pretty major renovations. The idea was to stay in the house long term, and so we wanted to factor that into any sort of plans to make sure that the house was going to last them, I guess, for the next part of their life. They also wanted to retire and were just a bit unsure about what to do with their super. They really were wondering whether they should pull their money from super and put it into an investment property or pay out debt, or how they were sort of meant to go about preparing for the next part of their sort of financial journey. Okay, so we started, obviously we cover a lot of things, but I want to cover some of the key things that we work through as part of the advice. So the first thing we need to do is we need to understand the family income. So obviously a big part of your expenses are your tax. So for the husband, he was paying about $53,000 in tax. For the wife, it was a little bit less at $11,000, but it meant that they had about $171,000 coming in per year, which is a good sum, and is really those couple of years of setting them up for retirement. We talked about the idea of buying another investment property, and really what we did is we tried to understand, I guess, their why, what they wanted to achieve out of the investment property. Is it the case that they were really passionate about it and they thought that they could add value, or what were we trying to achieve? And essentially it really came down to that they just really didn't understand any other way of building wealth. They didn't fully understand super, which is completely understandable. Super is very complex. And they were really just looking for something simple that would help them to sort of grow their wealth. But they were quite flexible and open to other ideas. And we talked about this concept about super being really good for tax. So super, when you retire, moves to a tax rate of 0%, which is amazing, right? Like, we don't want to be paying tax in retirement. Whereas I guess if we had an investment property, we would be looking to pay tax on that income. So it just didn't make a lot of sense necessarily to be paying additional tax. The other thing they wanted to do is they wanted to spend the capital. So the rent from their investment property, $510 a week was not really enough to cover their lifestyle. And even if perhaps they bought another one, it wouldn't be enough to sort of cover their lifestyle, and they'd probably need to, sell off the house at some point. Obviously, they can't sell off bedrooms as they need access to money. So essentially, even if they did buy a house, we'd probably be looking to sell it pretty quickly, with the idea that we're going to have all this excess money to then put, potentially into super anyway. So the house didn't necessarily make a lot of sense, but we talked through the pros and cons to get a good idea of what suited them. basically the way I think about these things is the order of importance is your lifestyle and then the investment strategy. I think sometimes people, when they think about a financial plan, they start with, okay, well, I want to buy an investment property or I want to buy shares, or and in reality, those are the tools that we use. What's really important is your lifestyle and then fitting in the tools to simply achieve this. Cool. Awesome. So in order to sort of move into retirement, we wanted to understand, I guess, how much they earned, but also their lifestyle expenses. And even when you're retired, having a good idea of how much your life costs to live is really valuable, because it allows you to make more informed decisions about pulling money down from your investments, how much you're going to need every year to do so, and also how long those investments might last. So you can make more informed decisions about when you're going to leave your job, or how you're going to go about things. So listed out loosely that they spend about $115,000 a year. Mortgage repayments are about $22,000. They take sort of a small holiday every year or a bigger one every couple of years. Spending money, and then sort of general costs as well. And we broke that down into significantly more detail. We then sort of gave them a little bit of a structure about how we can structure bank accounts. So particularly as we move into retirement, we just don't want one big pool of money that we're sort of hesitant to access. So essentially we put money aside in a bills hub, we put money aside in a holiday account, and we put money aside in a spending account. And even when we move into retirement, we do want to start drawing money similar to a wage and assigning money to this, so we can have certainty that we have money going in all the right places. But going through this exercise allows us to go, well, if they earn $171,000 and they spend $115,000, they have about $55,000 excess a year, which is quite a lot. And they are at the peak of their careers, so that's very understandable that these are these good years to sort of put some money aside, particularly now the kids are a little bit older. We did a bit of analysis of their investment property. Essentially, their rent was about $26,500 a year. They pay real estate costs, they pay costs for the thing, they pay mortgage repayments, and essentially we found that their costs were exceeding any money they were making from it by about $2,800 a year. So it was negatively geared. They did receive a small tax benefit for that, which is approximately about $1,100. So every year they've got to put $14,000 into this investment property. It's essentially losing money every year. With the idea that hopefully it's going up in value, but we really, this outlay of cash is fine whilst we've got good incomes. Once we move into that retirement space where we don't have excess money to be throwing around, it is going to create a bit of an issue, and it's something we need to think about. So there's three scenarios we really wanted to address here. The first is how much they're going to have when they retire. They were looking to retire when the husband turned 65, so it's only a couple of years away. They wanted to understand, I guess, if they sell their investment property and use the funds for the renovation and to pay out the home loan, how much that they're going to have. And they wanted to, I guess, understand how much super they're going to need by understanding when it's going to run out. So we ran three scenarios here. The first scenario, what we did is we maximized super contributions and we paid off the house. So in this scenario, both the husband and wife contributed up to the concessional contribution cap, which is the amount you can contribute to super and get a tax deduction. And then we directed excess funds to the home loan. Now in this scenario, the outcome was the house is paid off in 3 years. They saved a substantial amount of tax because obviously those super contributions are really reducing tax quite a lot. And at retirement, when the husband is age 65, they had about $1.1 million in super. They also had the investment property, which had about $400K in equity, but it is in a negative cash flow position. So we need to be thinking about what that's going to mean in retirement, sort of thing. We ran a second scenario, and again, it's way more detailed than what we've got here, but essentially we said, okay, well, what if we sold the investment property in the first year of retirement, and then we use the money to do renovations and to fund lifestyle from there. With the sale of the investment property, we suggested doing it in the year after, or the financial year after ceasing work. And the reason we did that is to reduce tax payable on it, because there is going to be a big chunk of tax payable. We also wanted to do those 300K renovations, which ate up a lot of that investment property. So we really just wanted to see what that looked like. Now in this scenario, the house is paid off still in 3 years. We sell the investment property in the tax year after retirement. We pay for the renovations, and then we have about 100K left over for sort of lifestyle expenses. At age 65, we still have about 1.1 million in super. So essentially what we're doing is we're trading the investment property for the renovations sort of thing. So that's kind of where we're at. Scenario 3, we factored in drawing down on super. So let's say we have about 1.1 million in super. And I've noticed there I've just written a combined super balance of 1.5, but 1.1 million in super, and then drawing down lifestyle expenses about 100K an annum, drawing them annually at 2%. So what was the outcome here? So essentially they're drawing down every year. The Centrelink age pension starts to kick in about 69, 67 when the assets fall below the threshold that you can have before you can access super. Centrelink, and then their superannuation is extinguished about 84, 82. At that point, they're either relying on the full age pension or they need to downgrade the house and start to sort of think about trying to get money out of the value of that. In reality, we've factored this out for quite some time, and it's likely their spending is going to reduce anyway leading up to that period. So I suspect that they will be able to have enough to sort of last them through that period. But it is kind of highlighting that 1.1 million is, potentially meaning that they're going to need to make more informed decisions about how they spend. It's not going to be an endless amount of money that's going to last forever. So it kind of allows them, I guess, now that we're a couple of years out from retirement, to sort of make that call about whether they want to work a little longer, try to get a little bit more money. Maybe they want to spend a little less on the renovations, have a little bit excess money from there. It just allows us to have better discussions about what we can do sort of thing and what's possible. Now, in terms of their super strategy, we wanted to keep it really basic. We really wanted to focus on a low-cost super fund. We started thinking about the investment strategy, and I'll talk about that in a sec, and also ensuring that we're nominating each other so that if we are to pass, it goes to the other person. If you don't have a nomination in your super, the super fund does get to decide who gets your money. And particularly, once we've got, adult children involved and partners and stuff like that, we want real clarity as to who's going to get money, just to make sure that you don't have any sort of disputes if you were to pass, right? So essentially their investment strategy, we looked at a couple of things. So we essentially set up two buckets. We set up one bucket which was sort of lower growth, low risk investments. These are the ones that don't climb a lot, they don't grow as much, but they're more stable. They don't do this up and down as much as perhaps a higher growth investment. The second bucket was a growth investment. So it was about 70% growth, 30% defensive investments. With the idea that we're going to adjust that as we approach retirement. So when we put this plan in place, the market was quite down. There wasn't necessarily a big capacity for it to drop too much more, potentially. I mean, we never know what's going to happen in the market, and they felt comfortable to sort of have a little bit more in growth. A common mistake when it comes to retirement is people put too much of their money into sort of low growth investments. And considering you're going to live, 20, 30 years in retirement, we do still want to be pursuing some growth if we feel comfortable to do so. And they were comfortable with that. The super contribution strategy. So again, what we're doing is we're contributing to super to try and reduce tax as much as we can and really get that flywheel of growth going. So what we were doing is we're salary sacrificing with their employers up close to the concessional contribution cap. And then from there, what we're doing is we're topping up each year up to the cap. We want to be trying to maximize as much as we can. Because we're putting money into super not through the employer, we want to make sure we're claiming the tax deduction and we're including it in their tax return every year. So this is the strategy we're doing in addition to the investment strategy that we talked about. In terms of their debt, focusing money on directing money to the home loan. So the best place to put that is the offset account to really reduce that interest. Once that home loan is extinguished, then what we're doing is we're directing money towards the investment property. We haven't suggested putting money onto the investment property straight away because all of that debt is deductible debt, whereas the home loan debt isn't deductible debt. So that's the strategy there to make sure we're sort of maximizing these tax outcomes. So essentially, a couple of things have come out of this advice. The first is we've reduced their tax substantially. For the husband, some of his tax rates are, getting up to 49% if he goes over that sort of 180K. So reducing contribution, any super contributions are taxed at 15%, which is just a really big gain. It's also any of the investments are earning money, and they're earning money and being taxed at 15%, which is a lower rate. And once we move that to a pension phase, once they retire, we'll be able to get a 0% tax rate. So we're paying a lot less tax than what they were previously. We were able to achieve the renovations, pay off the house, and we've got a bit of a plan about how we're going to do that, which is great. And really understanding retirement lifestyle. So this kind of gives a little more clarity about what retirement's going to look like, how they're going to achieve it. Now, obviously, there is no right way to do this, and we've used a number of assumptions, and things can happen, but this kind of allows us to have better conversations about when we want to cease work, how we want to spend money in retirement, and some of the bigger spends we want to do. We provide ongoing advice to these clients, so that was sort of the plan we set up. The ongoing advice, essentially what we're doing is we're regularly adjusting their investment strategy. So as they approach retirement and they move into retirement, we want to start moving some of that money out of high growth into sort of lower growth investments, or moving them simply into cash. So we're really focusing on trying to make sure that we've always got access to money, and if markets go really poorly, then we have money to lean on without having to draw from our sort of higher growth investments. We've assisted them with timing around selling the investment property. So this is still to come, but we want to make sure that we're selling that investment property in a year where we're not working, just to make sure that we're reducing our tax. The less you earn in a tax year, the less tax you pay, because it's a sliding scale. So we just want to make sure we're going about that in a sensible way, because timing can make $100,000 difference here. Like, it can make a really big difference. Each year, we're doing those super contributions, we're keeping track of them, we're contacting them at the end of the financial year to make top-up contributions, and then we're liaising with their accountant just to get those tax discounts back. And then what we're doing is we're doing quarterly reports, tracking their spending and adjusting their plan if needed. These guys are in a great spot. If they want to spend more money, that's actually no problem at all. All we need to do is adjust the plan. So say, for example, they're like, look, each year we don't want to spend $6,000 on holidays. We want to spend 15. Okay, well, what does that mean? Maybe we work for an extra 6 months. Maybe we pull back the renovations a little. Like, there's a lot of levers they have to pull here. So we're just constantly thinking about what is lifestyle looking like and how can we adjust that to sort of suit our plan. When they approach retirement, we're going to run all these scenarios again. So we've used a lot of assumptions around investment returns, spending, etc. We will have a better idea, having worked together longer term, of all those sorts of things. Number of things can happen in the next couple of years. Maybe they'll get pay rises. Maybe investment returns are going to be greater or less than expected. Maybe something big will happen, like a health scare, which will cause them to want to retire earlier, or spend more money, or whatever the plan is. We want to adjust it. Leading into retirement and finding what I call your retirement number is a very personal decision. Essentially what we're doing is we're looking at how much money we have and going, look, I think this is it for the rest of our lives. I think this will last us. And at any number, that is stressful. So really getting comfortable around this allows us to then make more informed decisions and go into retirement without any concerns. One of the greatest issues, I guess, with retirees is they actually draw too little from their investments. That big pool of money, the fear of it running out, means that they're really worried about drawing from it, and what they end up doing is passing at a much older age with a lot of money left over, which could have been used for lifestyle in that retirement. So we want to go through this exercise to make sure you're getting the max out of your retirement. We want you to be spending your money. The kids can earn their own money. We don't want to be giving too much in inheritance. We want you to be living the lifestyle you want, because it's the next sort of 20 to 30 years is a big length of time. We just want to make sure we're getting the most from it. So that's loosely what a plan looks like for people approaching retirement. There's a lot more to this, but I just wanted to cover this really quickly. But I hope that's helpful. And if you want to have a discussion, please reach out. Cheers, guys.